So this slide right here is basically just the word salad version of the graph that we just saw in the previous video. But it does a good job, I think, explaining, at least in words, what's really happening here. So the asset, we know the prepaid expenses asset, when we first record that, when we originally record that, that's an increase to our assets, right? So this is the prepaid rent, think of it that way. So we've got that prepaid rent account up here. Okay, so let's just do it in a T account. What's that look like? So we paid $180,000 for prepaid rent at the beginning of December, right? This was December 1. So what happens on December 31st? We've used a month's worth of that. Well, what's 180 divided by 12? It's 15. So we have $15,000 of it that we've used, and we'll put that in negative. You wouldn't typically see negative numbers in your T account, but I'm just putting this here to remind you that this reduces the amount in your prepaid rent. This credit here on the right-hand side is going to reduce that amount. So that's going to leave us with $165,000 in our prepaid rent account. We have used this on December 31st. We have used this much of our resource, right? So just do a little smiley face, and remember, use these T accounts. They're going to help you walk through these, okay? So just like the second bullet point here says, as we use that up, so each month we'll make an adjustment here, right? Or every 6 months or every quarter, or however often you're reporting, you make that adjustment, okay? Deferred revenues are kind of the same thing, just the opposite side of the coin, right? So these are increases to liabilities when we first see them. We know that because we got the word obligation here. These create an obligation for us. So this is you paying me $1,000 to paint your house, right? So I've got my unearned house painting revenue right here. So unearned house painting revenue. You gave me $1,000 to do it. This was on December 1st. On December 31st, I had done $500 worth of the work, right? So I'm going to make that adjustment. And now I see, well, I've got $500 left in unearned revenue, right? I've earned this 500. Okay? So that would be recorded as revenue. Okay? But remember, these create an obligation for your company. Okay, again, a little smiley face because, hey, these T accounts will help you follow the flow of the transactions if you actually use them. So let's talk a little bit real quickly about accrued expenses and accrued revenues. What does accrual mean? Well, when we're talking about it in terms of accounting, an accrual means we're pulling something into the present. We're pulling a future expense into the present, right? So what's going to happen here, so an accrued expense, this is your accounts payable, right? So if you remember what we did originally for accounts payable, this was transaction 4 or something like that, I believe, where we bought $14,000 worth of supplies on account. What did we do? Well, we debited supplies, our new resource, right? This was our new asset for $14,000. That was an increase. And we increased our accounts payable. That was a liability for the same amount of money. Well, what happens as we use up these resources, right? Well, we have to recognize that expense as we pay those, as we use those resources up, okay? So as we use those resources up, we're going to say, and I think the example in this chapter is at the end of the period, you see that you have $4,000 worth of supplies left, which means we've used $10,000 worth of supplies, meaning that now we would go supplies expense because we've used that resource for $10,000, and we would credit supplies for the same amount. Okay, so that's an increase in expense, that's a decrease to an asset and an increase to an expense. Okay, it will make more sense the more often we do this, but just know it's the same thing. We're just recognizing the usage of those resources, right? Accrued revenues, these are your AR, your accounts receivable. Okay, this is when customers promise you that they're going to pay you money, so they owe us, right? AP is we owe them. Okay, so this AR is telling us they owe us. We have performed a service, we have provided a good for them, and they haven't paid us yet. Okay, we're going to create that accounts receivable account to remind us that they owe us some money, and as they pay us money, we're going to recognize, we are going to reduce the amount in that receivable account. So we'll increase cash, reduce accounts receivable. But when we recognize that accounts receivable, when we first record it, we're going to record revenue, right? Okay. So you're going to have AR as a debit, and as a credit, you will have revenue. That's your original entry, okay? So just remember that when we get accounts receivable, we're going to recognize revenue. So again, this is just the wordy version of what we just said. So accrued expenses or liabilities and expenses. So when we incur those costs, something like salaries, and we'll walk through a salaries payable example here shortly. We recognize those costs, costs during the period, but we do not pay those costs until the next period. We accrue those to the current period, right? So we're taking the current period and we're pulling them forward, right? That's what we mean when we say accrue. We're pulling those into the current period. Accrued revenues, the same thing. This is when we provide the good to the customer, or we provide the service to the customer before the payment is actually received. Okay, we have the right to receive cash from that customer. Okay, and we're going to record AR is the amount we're owed, right? Okay, so if you have any questions about accruals, deferrals, anything like that, please do not hesitate to contact me so we can talk about them in more detail, talk about them further, because they really are going to be kind of the bread and butter of this class moving forward. We will ask lots of questions about this is your new balance, what happened throughout the month. Tell us what happened, what accounts increased, what accounts decreased. So just get familiar with those concepts, and if you're having trouble with them, please do not hesitate to contact me. So in the next video, what we're going to do is we're going to go over each of these transactions and show you how we make those journal entries and how they are impacting our accounting equation.